Trump believes in a weak dollar. He absolutely does. I've had this discussion with him 100 times. I was one of the king dollar guys in the last administration, along with folks like Larry Kudlow and to a certain extent Gary Cohn, and we lost every single time. He absolutely believes that a weak dollar is good for the country.
Hello, everyone, and welcome to this week's episode. I'm Yuban Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore, and today is Friday, the 6th of June. We take a bit of a detour from our usual week-ahead discussion and instead focus on Nomura's views on the outlook for the second half of the year. We held our flagship conference, the Nomura Investment Forum Asia, or NIFA, in the last 3 days, so we took the opportunity to sit down with colleagues and do this episode in person, discussing our strongest calls, as well as some investor feedback which stood out to us at the conference. The main themes were unsurprisingly centered around US trade and fiscal policy, tensions with China, geopolitical risks, and de-dollarization concerns, perhaps fueled further by views from keynote speakers, as you heard earlier there from Mick Mulvaney, former acting chief of staff in Trump's first administration, who spoke at NIFA. We also got some insights from officials on how other economies are trying to cope, as well as how market participants are navigating the still highly uncertain global backdrop. We have an all-star cast in this episode, and I'm thrilled to be joined by David Seif, our Chief Economist for Developed Markets, Dominic Bunning, our G10 FX Strategist, George Buckley, our Chief Economist for Europe and the UK, Sonal Varma, our Chief Economist for AEJ and India, and last but not the least, Ting Lu, our Chief Economist for China. So let's get to it and hear their thoughts.
These tariffs are leverage. That's it. They are not here to sort of stay forever in order to bring back footwear into the United States or textiles. They are there to try and cut better deals.
All right, my first guests are David Seif, our Chief Economist for Developed Markets, and Dominic Bunning, our FX Strategist for G10, and of course, a co-host in this podcast. Welcome to both of you, and I'm really glad we can do it here in person at NIFA. You've traveled all this way, so I'm grabbing this opportunity to be able to speak to you guys instead of virtually. So let's start with the second half outlook, and I want to zoom in on your high conviction views. Starting with you, David, you're expecting U.S. inflation to pick up, but growth to slow materially, although avoiding a recession as a result of the tariffs. When will that start to show up in the hard data in the U.S.?
Yeah, well, that's exactly right, and I think that it could really start to show up quite soon. So on the growth side of things, we've seen, and I don't want to overstate it, but we have seen a bit of a pickup in initial jobless claims numbers, and that is leading us to think that the NFP print, or the employment report, will be on the weaker side this Friday of just 110K. And then next week we will get inflation data. We haven't come out as of the recording with a forecast for this specifically, but we would think that the May or June numbers, which will print in June and July respectively, could easily start to see the impact of goods inflation starting to rise as a result of the tariffs.
Right. And on the Fed, I guess our house view is they don't start cutting again until December. What's the rationale for that timing, and what's the risk around that?
Yeah, well, that is a view that we have held for quite some time, which is a little bit less out of consensus than it was before, as sort of the market has repriced. But our view on this is basically that the slow growth and increase in inflation really pulls the Fed in two different directions. And listening to what almost every Fed speaker has consistently said, really since about December last year, with perhaps the exception of Governor Waller, it's that to the extent that the Fed is being pulled in different directions on its two mandates, it will prioritize the mandate where it's further from its target. And that is a sort of code word for it's going to prioritize inflation, because right now we have 4.2% unemployment in the United States. That is very close to full employment. And so it's hard to argue that the Fed is anything but at target in its mandate for full employment. However, we still see core PCE inflation in the high twos, above the 2% target. And our forecast is that it's going to start climbing again, so moving further away from the target. So when you listen to what the Fed has said and apply it to what the data actually look like right now, that means that the Fed is likely going to prioritize inflation and hold rates at the current 4 3/8, but until it starts to see inflation prints come back to a point where they're consistent with 2% inflation in the long run. We don't see that happening until Q4 of this year, and that's why we say no cuts until December of 2025.
Okay, that's very clear. And Dom, same for you. Any major themes you're watching out for in G10 FX for the second half of the year, and any high conviction views on that?
Yeah, thanks for having us on. I mean, the base case for us is that the dollar does have further to weaken. We've been arguing this for the last couple of months. And, in terms of how far we can go, I'd say in G10, it's a range, between 5 and 10%, depending on which currency you're looking at. But I do think there's still some room for the previously very strong inflows into the US to slow because of this sort of softening growth environment. So really what we're talking about is a little bit more of a cyclical play against the dollar, more so than a big structural shift. And I think that's quite an interesting debate that's going on in the market right now. And certainly some of the discussions we've had this week with investors have focused on whether this is the start of something more structural or if it's just cyclical. For now, I would say, the currencies we do see benefiting the most are places where we've seen strong outflows into the US, where there could be a little bit of repatriation, or where there's just going to be sort of enough liquidity to some extent to benefit from being almost a dollar alternative in the short term. So things like euro dollar moving up by 5, 6, 7%, that kind of range. Dollar yen, I think, heading lower fairly clearly as well in our views. But it's not all really strong appreciation versus the dollar. I think something like sterling, for example, will probably underperform against the euro. So we'd have euro sterling heading higher as another kind of key trade idea for the second half of the year.
Okay, and the big picture question we're getting a lot, and we're getting this even in Asia in terms of de-dollarization. What's your thoughts on that?
Yeah, I think there's an element of truth to this idea that investors are going to allocate a little bit less of their, marginal capital into the US, I think, and part of that is the cyclical story. I suggested, are we at the start of a multi-year or multi-month, shift away from US assets, a big selling of dollar assets? There, I'm a little bit more skeptical. As I say, we haven't really seen any evidence, or certainly not much strong evidence of that in the data that we can track up until this point. That doesn't, not to say it won't happen, but it certainly hasn't come through yet. I think the big questions for me are sort of, things like how is the dollar behaving relative to US Treasury yields, relative to US equities? If some of those correlations break down in a more permanent way, then that could precipitate a different type of investor behavior, which would be more of a structural kind of dollar lower theme. And the other thing I think we do touch upon with investors is whether or not this administration is creating more of a lasting damage to the US institutional framework. Now, at the moment, yes, there's a lot of policy volatility. It's very uncertain. But again, I think it's probably too early to kind of make that bold claim that the US on a kind of multi-year basis is in a much worse place than it was, just a few months ago.
Yeah, interesting. Thanks. And of course, we had that survey question in our first session yesterday at NIFA. Basically, the response was an overwhelming yes that the US dollar remains its as a global reserve currency. And speaking of that, and this is the final question to both of you, you've had a lot of meetings with clients. You've had all of these survey questions in your sessions at NIFA. Anything that struck you in terms of those views from investors, and what's your response?
Yeah, I'll say what struck me the most was the lack of strong views at this point. I think that the unbelievable amount of volatility that has occurred out of the United States over the past couple of months has left investors really low on conviction level at this point. And so one overwhelming theme that I've heard is that to the extent that investors have a certain risk budget, they've only used a relatively small percentage of that, waiting for some sign of which direction things are going to go.
Yeah, I'd echo that. What David says. When we ran some of the surveys, as you said at the conference, the consensus view amongst the people there was, for example, Eurodollar would be between 115 and 120 by the end of the year. So even though there is a consensus view that the dollar will soften, it's not a particularly extreme sort of consensus view. And I think that, speaks to David's point about a bit of a lack of conviction, not really knowing exactly where US policy is going to be in a few days, let alone a few weeks or a few months. But also, some skepticism or questioning about how that impacts the rest of the world. We've had some interesting debates about Europe, and I'm sure you'll talk to George at some point on this podcast about that. But, almost, is the Trump administration a good thing for Europe because of the way in which Europe has to react, or is it still going to be a negative through the kind of trade channel and through the tariff channel? And I think there is still a lot of uncertainty there. So yeah, it's very hard, I think, for investors to really have strong convictions at this point, understandably so.
Yeah, absolutely. It's a high uncertainty. So yeah, thanks both. I know you have to run to the airport and fly to Hong Kong, so safe travels, and thanks again.
Thank you.
Thanks, Eben.
And I'm very delighted to be joined by George Buckley and Sonal Varma. Thank you both for coming into the podcast in person for the first time.
Thank you.
Great to be here.
So let's start with you, George. In your presentation at your NIFA session, I thought you drew some smiles from the audience when you said Trump could make Europe great again. What's the idea?
Mega, absolutely. We've even had the hats made. And we're quite optimistic. We're constructive on Europe in the longer term because we're seeing, I think this is the kick that Europe needed in order to do a lot of the things it should have been doing a long time ago, whether that be increased defense spending, for Germany, increased infrastructure spending, a huge amount of money at stake here. We're talking about, for the infrastructure fund, around about 1% of GDP every year. So that should have a meaningful effect. The issue is it's going to come into effect over time. You probably won't see the effect on the supply side of the economy for a while, but overall, we're very constructive in the longer term.
Yeah, great. And Sonal, I guess Asia's theme is what you call controlled descent, but it's a bit of a mixed bag. There are leaders and laggards. Which are these countries and what's driving the wedge between them?
Yeah, so, the theme is there is going to be a glide down on growth, but not a dive. So the region has stronger fundamentals. But as you said, a lot of idiosyncrasies and differentiation is quite important. So the leaders in the pack for us are India, Malaysia, and Taiwan. For India and Malaysia, we think the domestic demand is going to stay strong. The supply chain relocation is a tailwind for these countries. And for Taiwan, the AI theme we think continues to roll on. So that'll be a big growth driver. The laggards within the region, in our view, are Thailand and Indonesia, both countries where we think growth will be weak. And for Thailand in particular, the China shock is a major driving force, and we think there is a risk of entrenched deflation there.
Yeah, interesting. And for both of you, I guess the shock from the tariffs for the U.S. would be inflationary, but for the rest of the world, it's a demand shock, and inflation is going to be very benign. So from a central banking perspective, how much lower do you think rates can go for your regions?
Well, let me kick off. The ECB has looked into what they think is the impact of tariffs on the European economy. They think it's going to take 0.5% off economic growth. I suspect by the time this recording goes out, we will probably have a new forecast from the ECB. The ECB, of course, is meeting this week. And I imagine they will say it's much bigger, the effect. The bigger effect on growth means there will be a larger effect on inflation on the downside. Don't forget, you've also seen the dollar weaken. You've seen the euro strengthen. At the very start of this year, we were questioning, is the euro going to go below parity? Or at least some people were questioning that. We're now expecting the euro to go to 120 by the end of this year. That should be a very powerful disinflationary force, and the possibility that China starts dumping goods into Europe. All of that could mean that we see a disinflationary move. And of course, that's supportive of the view they need to cut interest rates further.
And the theme is, of course, quite similar in Asia as well. And I think the important point is for most countries, we are expecting inflation to be below the central bank targets. So this is important because it does mean that for many countries, policy rates will not just go down, but potentially go down into more accommodative territory, not just stop at neutral. I think the one pushback we keep getting is how can Asia cut rates if the Fed is on hold? But we do think this cycle is a bit different. Countries and central banks can decouple from the Fed because unlike the past cycles, we're actually seeing Asian currency appreciation at a time when exports are slowing down. So we think there will in fact be even more emergency need for the central banks to be accommodative. So we do expect deeper cutting cycles across many countries, but I think the ones to really highlight would be Thailand, India, and Philippines, where we think rates will be more than consensus is expecting.
Yep. And George, you didn't mention the Bank of England.
Oh, I didn't. So the Bank of England, we're also expecting them to cut interest rates, but we don't think they'll go quite as quickly. We think they'll cut by 3 more, which is August, November and February. So we've got down to 3.5%. That's a big difference between the ECB and the Bank of England. We've got the ECB going below neutral at 1.5%. We've got the Bank of England probably staying on the upper end of what we think might be a neutral range, so 3.5%. One of the reasons for that is that wages have just tended to be a bit more sticky in the UK. And I think that will mean that services inflation probably is also a bit stronger than it is the case in the euro area.
Yeah, so definitely some differentiation within your regions. Shifting gears a little bit to fiscal policy. And George, you mentioned Germany and fiscal spending. And then, of course, in Asia, we're arguing that fiscal deficits could be higher. Could you elaborate on that, maybe starting with George?
Sure. Germany has a lot of fiscal space. I mean, I say that, but actually, if you look at it relative to the Stability and Growth Pact, which requires countries to remain within 60% of debt to GDP and within a 3% deficit, Germany, on its current trajectory, the IMF thinks they'll be running deficits north of 4% and getting to about 75% debt to GDP. It's not high by cross-country standards, but they are going to breach those targets if they do what they say they're going to do. Not every country has fiscal room. France is a good example. The UK is a good example. Italy, all good examples. Big countries in Europe. Only Germany really has that fiscal firepower.
Yeah, so I think Asian fiscal policy is at an inflection point now. You know, what we've seen so far is more monetary policy action. For countries where there is room, we do think growth supportive fiscal policies will step in. And I think like over the more medium term, increased defense spending in Asia is also likely to be a theme, which will also require more fiscal spending. So of the countries we look at, we think Korea, Taiwan, Singapore, and Thailand are the ones where we will also see expansionary fiscal policies.
Okay, great. And final question. You've had some meetings while you're here and some polling questions we did in your sessions at NIFA. Anything that stood out to you and was surprising? George?
Well, my greatest disappointment is that I didn't convince the delegates at this conference that it was going to be make Europe great again. When we asked the question, will Trump's actions make Europe great again? The answer was 45%, so a plurality said no. However, I'm going to take the optimistic side of this. I'm going to add the yeses and the maybes together to get 55%. So actually, I think probably people do think it's good for Europe in general.
And so?
Well, I think the big question, I think for most countries in Asia is, do they align more with the US or China? And I think particularly for the ASEAN countries, where they move, I think is the question. So in our audience poll, actually, it was a unanimous well, not unanimous, but an outright 80% vote that ASEAN countries will hedge between US and China, which makes sense. I mean, US is an important end market, but China is also a very important source of trade and investment. So this is a theme, of course, we will be tracking in the coming months and quarters, I'm sure.
Yeah, I was also very surprised by that overwhelming majority. I thought there was a little bit more of a chance to pivot to China given what's happening recently. But yeah, again, something we will watch very closely. Yeah, excellent. Thank you both for joining today.
Thank you so much, Yuban.
Thanks, Yuban.
Okay, finally, I'm joined by Ting Lu, our chief China economist. Thanks, Ting, for being here despite your tight schedule and doing this podcast in person. So first question, I guess we'll just focus on your highest conviction views. And you're expecting for China's growth a fairly significant slowdown in the second half. So talk us through the rationale behind that forecast.
Yeah, thanks, Yuban. Thank you for having me here. Yes, we do believe economic growth will slow in the second half this year. Maybe it's a consensus, but maybe our belief is that the scale of slowdown could be bigger than markets currently think for a few reasons. The first reason is that we are seeing very strong exports now. This is good, but maybe this is also bad for the second half this year. This is good because because of the Geneva agreement, there's a very big slash of tariff rates on Chinese goods, on American goods. And so then we have some pent-up demand. And we also have some front loading because people are very much concerned about uncertainty about the results of the negotiation for in the next 70 days. But the problem here is that we will have a slowdown of exports in the second half this year. But then we have another reason to be concerned about the trading program, which have pushed up durable goods sales in the past 8 months, will also be over very soon. And the real problem here is that durable goods cannot be stimulated forever, and there will be some payback. And I believe the payback will be in the second half this year. And the last reason here is that the property markets in China continues declining at annual rate about 10 to 15%. And with the slowdown of exports and with the slowdown of durable goods sales, my concern is that the property markets will perhaps even see worse performance in the second half. So that's why if we summarize all the concerns here, and I do believe that the slowdown of the economy in the second half could be bigger than people may think.
Yeah, indeed. And I would note the session that you had yesterday at NIFA when we had the survey to the audience. They seem to be a little bit more optimistic when it comes to the growth outlook for the second half of this year. So on that note, Ting, the growth outlook that you're expecting, is that going to be bad enough for Beijing to finally implement some cleaning up measures, in particular for the property sector, which, as you've mentioned before, they seem to be fairly hesitant to do that before?
Well, still it's very hard to say. Maybe the answer is not a yes or no, but I think the chance for Beijing to do something on the property markets finally will rise. So perhaps maybe in Q4, not in Q3, the slowdown will be big enough to convince Beijing that it's a time just for Beijing just to do something real. Now, this time around, they cannot just do the debt swap for the local governments. They cannot use the trading program again because the marginal benefits will be much smaller than before. And maybe there's not much else they can do on exports. Depreciation is not option for Beijing. So I believe that maybe for the first time in the, let's say, 4 or 5 years since the collapse of the property markets, they need to clean up a lot of those non-performing loans, especially for those homes that Chinese people paid but are waiting to be delivered. Of course, there's a lot of other non-performing loans between developers, the constructors, raw material providers. And I think the Chinese government just need to get in and just to clean up a lot of those loans here.
Okay, yeah, that's great. And finally, I guess the main topic, and this was obviously the big question that we were asked in the conference here at NIFA, is the the outlook for the U.S.-China trade tensions. And as you've been noting in your reports, the tensions are rising again on multiple fronts. So how concerned are you?
Yeah, well, overall, I'm concerned, and it's not just for this year. I think maybe for the next 3, 5, or 10 years, I think this will be the big trend. So although we have seen some good news, especially in Geneva, so this is really nice. I think, leadership on both sides realize that more than 100% tariff will really cease the trade between these two countries. Although I'm relatively happy about these results, but I'm concerned about the negotiation for the next, let's say, 70 days. It's still quite uncertain about results on tariffs, whether or not they will, let's say, slash the 20% tariff on the fentanyl, and whether or not they will, let's say, get any good results on a 24% reciprocal tariff. But overall, I think the real problem for these two superpowers in this year and in coming years is really about non-tariff measures. It's really about U.S. containment of China and China's response. So I do expect a lot of those non-tariff measures, maybe those measures on chips, on those chip-making equipment, on EDA, on some of the chemicals, of course, even on Chinese students' visa. But on the China side, it's also about the rare earths. So anyway, there will be a lot of issues which may not be directly linked to the tariff, but those non-tariff issues will really define the tensions between U.S. and China in coming months, coming years.
Yep, indeed, sounding very contentious. Yeah, always very interesting. Thanks, Ting, for joining the podcast.
Thank you, Yuban.
That's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out nomuraconnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.